Today, folks, we're diving down into 4 Canadian dividend stocks that are all yielding over 5% as of the making of this video. Not only that, historically, year over year, they've all increased their dividends. They all sit in completely different sectors, and if you're willing to hold this in a tax-free savings account or a registered retirement savings plan, you will pay 0 tax, which means for every $10,000 you invest, you will make $500 in annual dividends. If that is a conversation you appreciate, if you love passive income, consider hitting that like button, folks, because the first and foremost company I want to talk about has become very popular in the Canadian investing community, and that is a company called the Power Corporation of Canada. And no, this is not a utility, guys. This is a pure financial play, but what makes it so intriguing is they have a huge staked ownership in Wealthsimple and a few other trading platforms, but we'll talk about that in a second. Currently trading for a PE of 9 and a 5.07% dividend yield, guys. They just recently hit all-time highs and have recently been pulling back, which makes them an intriguing buy. And from a dividend standpoint, if we go all the way back, guys, to basically 2012, we'll take a 10-year time horizon here, we can see that the dividend was around 29 cents a quarter, whereas today they're sitting at 49 cents. That is pretty juicy for a company that's already yielding such a high level of output here from that dividend. So let's talk about the revenue breakdown, because they're involved with everything from life insurance to retirement planning to loaning money. And currently 45% of their income comes from Canada, 10% the US, and 25% Europe. But if we scroll down, as I mentioned, the most intriguing thing to me about this company is the investment in Wealthsimple. They have strategic investments making up 14% of their 2020 adjusted EBITDA. So this is just really intriguing, really well diversified, and just a mega cap company in the Canadian financial space. Leading us into numero dos, and these are just brief introduction, guys. I hope this intrigues you to do your own homework. Don't take this as financial advice, but here's one that I currently own called Enbridge, guys, and this one has been kind of following the oil market, being kind of an oil play, but let's talk about that in a sec. Currently yielding 5.95%, a little bit higher of a PE, in Canada's second largest company with $117 billion market cap. Recently has been rallying back with the commodity boom that we've been experiencing. And from a dividend standpoint, guys, going back to 2013 on the record here, from 31 cents a quarter to today, where they're yielding 67 cents in just under 10 years, that is a doubling of the dividend, and it's already starting at a 6%. This is an absolute marvel. And just taking a look, guys, the reason I like this personally is I don't like pure commodity plays. I'm really not the biggest fan of buying oil stocks that have direct exposure to the oil price. This company is just a pure, primarily pipeline-based company. They own the largest oil and gas pipelines that span all the way from Alberta all the way down to Texas in the entire Western world. They give you exposure to natural energy with renewables like wind that are currently being developed in the European markets here. So I absolutely love this one just for the pure stability aspect of not only the large market cap, but the fact that kind of moving into this the geopolitical environment with everyone trying to bring oil production back to the US, back to Canada here, and Canada basically having 10% of the entire global oil reserve. And this goes well beyond oil. They also are heavily involved in natural gas. Like if you live in Toronto, go look at any company or any house that has a natural gas pipeline set up and uses natural gas, you'll see the Enbridge logo on it. So this is an incredibly well diversified mega cap company in Canada. Now let's talk about a REIT. So we've talked about financials, we've talked about energy. Let's get into the real estate sector, because I know this is a favorite amongst many people out there, and SmartCenters is the one that's going to make this list for 2 primary reasons. The yield is over 5%, currently sitting at 5.61, a PE of just under 7. It's a $4 billion market cap, and the reason that I would choose this over all the other REITs right now, guys, is they didn't cut their dividend through the March 2020 crash. If we actually go back to basically 2012, we'll do a similar span here, and keep in mind this one pays a monthly dividend here, guys. In 2012, the yield was right around 0.12 cents, 0.13 cents, give or take 0.01 of a cent, whereas today they're now paying out 0.15 cents. Now 15 cents, it doesn't sound like a massive increase, but considering it's consistently has been going up and the stock has been relatively stable, surviving that March 2020 crash, the reason I personally love it is the tenant bases. Over 60% of their income is coming from things like Walmart, Loblaws, Shoppers Drug Mart, Canadian Tire, Lowe's, McDonald's, LCBO. This gives you like a third-party exposure to some of the most mega cap companies on the planet, like Walmart, that don't yield the highest yield, but you're basically getting that higher yield by owning the real estate that they're renting to operate these businesses. And on top of that, guys, we all know that Canadian real estate is in kind of bubble-ish territory, and a lot of people are relying on the government to fix this, but really you should be paying attention to these real estate investment trusts. They have made heavy investments for the next 5 5 years to basically start scaling condos and really building out the residential real estate market. This company is literally building cities around their malls, primarily these outdoor shopping centers. I mean, here's one that is just 20 million square feet that's going to come online. I mean, this company has a lot of projects under the works. That's why I added it to my portfolio. Now, finally, let's talk about the last one here, which is Bell. So Bell, BCE is the ticker here. This is the New York Stock Exchange ticker. This is also trading on the Canadian markets. I don't know why I pulled up the US market one here, but nonetheless, guys, Bell Telecommunications. Now, many of you know I'm a big fan of TELUS, but the reason we're talking about Bell today is because they are the one yielding the highest amount at 5.15% of a yield. And diving down into the dividend itself here, guys, because we can kind of all reminisce with what Bell is actually doing, but taking a look at the dividend history going all the way back again to 2012 here, guys, when they were paying out 54 cents a share, whereas today they're paying out almost 92 cents, damn near doubling that dividend. So these companies, for the yields they're paying and the results they've offered through all the history of the crashes, the pandemic, I mean, you can't really go wrong here, in my humble opinion. Now, Bell, guys, we all know, kind of a boring stock, but if your investments are exciting, you're typically making the wrong kind of investments, right? Now, they have $5 billion planned in capital expenditures in 2022 as they continue to try and expand into some new networks with fiber optics and many other aspects of the telecom sector. And they're obviously the largest telecom company in Canada, but taking a look at the dividend, they still plan on growing at 5.1% in 2022 this year. So we can see that their primary aspect is right around the dividend, which if that aligns with your investment goals, maybe you're at retirement, maybe you just want some backup cash flow, I think this is a great company for you. And if you just take a look here, guys, I mean, they're entering a second year of historic tier CapEx investment acceleration program, largest annual network build out ever with up to 900K new fiber optic locations passed in 2022, 80% of planned broadband internet build out program to be completed by this year in 2022, and accelerated 5G rollout to cover more than 80% of the Canadian population by the end of 2022. I mean, guys, these are like the most fundamental businesses that you use every day. And that's how I've always looked at dividend companies. Look, whether it's you're filling the gas in your car, well, make the gas companies pay for it. Buy Enbridge. Hey, you use your phone all the time. Well, if your phone bill, realistically, guys, is only $50 a month, it's about $600 a year, you'd really only have to invest $10,000 to $12,000 in Bell, and they will in perpetuity pay your phone bill for the rest of your life. This is why I absolutely love dividend stocks, and this is how I've always come to think about it, because people make investing very complicated, like you have to completely know the balance sheet, you have to listen to all these earnings calls, but really you don't. You just fundamentally need to know what the best companies are in your area. You need to be able to feel them, touch them, know what they're doing, and maybe just take a look into the future of where they're going, and usually you'll do just fine. But at this point, I want to pass the question off to you. What other dividend stocks do you guys know out there that are yielding over 5%? I really like each one of these because they all trade in different sectors, and I believe they're going to be very reliable into the long term. And I also plan on adding some more of these even into my own dividend stock portfolio. So stay cool, stay awesome, and as always, I look forward to catching you in the next one.